Before we begin, remember that this video is for educational purposes only and isn't financial or real estate advice. Always consult licensed professionals. Most first-time buyers make at least one of these mistakes. Let's make sure you don't. Most people focus on the monthly payment, but they end up paying hundreds of thousands more in interest than they need to. Today, I'm going to show you how interest rates and loan terms really work, so you can rethink guessing and start saving on your biggest lifetime expense. Alright, let's start with the real-world problem. Most homeowners don't realize that in the early years, almost none of their payment actually goes toward owning the house. This is the part that helps you understand what is actually going on before you spend money. When you make a mortgage payment, your money is split into two main buckets: the principal, which pays down the loan balance, and the interest, which is the lender's profit. In the first few years, the interest portion is massive, often making up 70% or more of your check. Understanding this split helps you see why your debt doesn't seem to move much at first. Always check your monthly statement to see exactly how much is actually building your equity. Amortization is just a fancy word for the math that ensures your loan is paid off by the end of the term. It's front-loaded with interest to protect the bank's profit if you sell or refinance early. If you look at an amortization table, you'll see the exact moment your principal payment finally overtakes your interest payment. This schedule is your roadmap for the next 15 to 30 years, so don't ignore it. Your down payment is your immediate stake in the property, and it directly affects your interest rate. Putting 20% down is the gold standard because it usually eliminates the need for extra insurance and gets you better terms. However, many people over-leverage themselves by putting 3% down, which leads to higher monthly costs and more risk if home prices dip. Think of your down payment as a shield against market volatility. Now let's talk about the price of the money itself. Interest rates aren't just one number, they're a reflection of the market and your personal financial health. A fixed-rate mortgage keeps your interest rate the same for the life of the loan, providing stability and peace of mind. An adjustable-rate mortgage, or ARM, starts lower but can jump significantly after a few years based on market indices. ARMs can be a smart move if you plan to sell within 5 years, but they're a massive risk if you plan to stay long-term. Always ask for the ceiling or maximum possible rate on an ARM before signing. Lenders often give you the option to pay discount points upfront to lower your interest rate for the life of the loan. 1 point typically costs 1% of the loan amount and drops your rate by about 0.25%. This only makes sense if you plan to stay in the house long enough to reach the break-even point where the monthly savings outweigh the upfront cost. If you're moving in 2 years, don't buy points. It's just a gift to the bank. Your credit score is the single biggest factor in the rate a lender offers you. A score of 760 might get you a rate that's 0.5% lower than a score of 660, which sounds small but saves tens of thousands over 30 years. Before applying, check for errors on your credit report that might be dragging your score down. Even a small 20-point bump can move you into a better pricing tier. Quick reminder, real estate markets and mortgage programs vary by location, so always verify with local professionals. The length of your loan is just as important as the interest rate. It dictates your lifestyle today and your wealth tomorrow. A 15-year mortgage usually has a lower interest rate, but because you're paying it off twice as fast, the monthly payment is much higher. A 30-year mortgage offers flexibility with lower monthly payments, but the total interest paid over 3 decades is staggering. Many savvy buyers take the 30-year loan for safety, but pay it like a 15-year loan when they have extra cash. This gives you the benefit of lower interest without being legally locked into the higher payment. Making just one extra mortgage payment per year can shave 5 to 7 years off a 30-year mortgage. When you pay extra, ensure you specify that the funds should be applied to the principal only, not the next month's interest. This simple strategy is one of the most effective ways to build wealth and eliminate debt early. It effectively turns a 30-year loan into a much shorter, cheaper one without a formal refinance. Some older or subprime loans include a prepayment penalty, which is a fee charged if you pay off the loan too early. This is a huge red flag because it prevents you from refinancing or selling your home without a massive financial hit. Most modern conventional loans don't have these, but you may want to verify this in your loan estimate. Always ask, Is there a penalty if I pay this off in the first 5 years? The interest rate isn't the only cost. If you aren't careful, the extras can add hundreds to your monthly bill. Private mortgage insurance, PMI1, is a fee you pay to protect the lender, not you, if you put down less than 20%. It doesn't build equity, it's just an added cost that can range from $50 to $200 a month. On conventional loans, you can usually cancel PMI once you reach 20% equity, but on FHA loans, it often stays for the life of the loans. Factor this dead money into your budget when comparing different loan types. Most lenders require an escrow account where they collect a portion of your property taxes and homeowners insurance every month. This ensures these bills get paid, but it means your monthly mortgage check is higher than just the principal and interest. Be aware that if your local taxes go up, your mortgage payment will go up, even with a fixed-rate loan. Always budget for a 3–5% increase in your total payment every year to account for tax hikes. Lenders are legally required to give you a loan estimate within 3 days of your application. This 3-page document is the only way to accurately compare different offers because it breaks down every single fee. Look closely at Section A for origination charges. These are the fees the lender is charging you to do the loan. If one lender has a lower rate but $3,000 more in fees, they might actually be the more expensive option. Before you sign anything, use this framework to make sure the loan fits your actual life, not just the bank's requirements. Lenders use your debt-to-income DTI ratio to decide how much they'll lend you, often allowing up to 43% or even 50%. Just because a bank says you can afford a $4,000 monthly payment doesn't mean you should. A safer bet for long-term wealth is keeping your total housing costs under 28% of your gross monthly income. Don't let the lender's math dictate your standard of living. Be cautious about the first mortgage offer you get, even from your own bank. Studies show that borrowers who get at least 3 quotes save an average of $3,500 over the life of the loan. Tell each lender you're shopping around. Often, they'll suddenly find a way to lower their fees or match a competitor's rate. This is one of the few times in life where a few phone calls can save you thousands of dollars. Interest rates change daily and sometimes hourly. A rate lock guarantees your interest rate for a specific period, usually 30 to 60 days, while your loan is processed. If rates go up while you're locked in, you're safe. If they go down, you might be stuck unless your lock has a float-down provision. Always get your rate lock in writing and know exactly when it expires, or you could face a surprise cost at closing. The big idea is to look past the monthly payment and understand the total cost of the debt over time. By choosing the right term, shopping your lenders, and paying attention to the amortization schedule, you can save a fortune. Don't be afraid to ask tough questions. It's your money and your future home. If this guide helped you feel more confident about your mortgage options, like and subscribe. For more tools to help you navigate real estate decisions with clarity, visit us at Reledemy. Thanks for watching. Subscribe for more real estate and mortgage guides explained clearly. Thanks for watching. Remember, this is educational content only. Consult a licensed real estate agent or mortgage broker before making property decisions. Subscribe for more.